Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at PayPal this morning. Their Q2 earnings are out and they are mostly good. One or two negative things I see in there that might be driving a slightly negative reaction, but in general, all things are positive. And as a PayPal shareholder, I'm pretty happy with what I'm seeing. I do own PayPal in my stock buyback portfolio. I've done some videos on that portfolio in the past. I will link the latest one down below, and I'll link my latest PayPal video as well, in order for you to get more background about the company. In this video, I'll mainly dive into the details of the earnings themselves. If you're new here, remember to like and subscribe. And while you're being a super cool person and doing that, we'll dive right into the earnings themselves. I honestly expected net revenues to probably be close to flat. They talked about some headwinds in their Q1 earnings call around some negotiations in their Braintree product, but revenues are up 5%, probably about 250 basis points better than the market expected. Transaction margin dollars up 7%. GAAP EPS and non-GAAP EPS growing close to 20% or 20% in the face of EPS. Free cash flow a bit lower than the market expected, down about 42% from the prior quarter. But again, it's timing of some working capital stuff, so that's not a huge issue in my mind. They're still guiding to the same free cash flow they guided for full year 2025. So it's just moving the cash flow to another part of the year. Balance sheet still looking really good. Cash and cash equivalents of 13.7 billion, some debt totaling 11.5 billion, and they're continuing to buy back shares. That's really the key with this company. You get a pretty good valuation, something around an 8 to 9% free cash flow yield. As of today, it was trading closer to 10 to 11% when I was buying it in the $60 range when I made my last videos. So it's gone up a bit since then, but they're buying back shares at that free cash flow yield. So you're reducing share count quite substantially. They reduced the share count by another 22 million shares in Q2 2025. So that's off of a share count in the high 900 million range. So pretty good basic returns for investors through that. On top of that, you're getting the revenue growth, the bottom line growth, and other things that may come in the future from some of the things they're working on right now. And then diving right into the presentation they released with the earnings, a big focus on transaction margin dollars continues. That's up 8%, excluding interest on customer balances. Venmo really growing at a good clip. That's one of their growth drivers, up more than 20% quarter over quarter, 60% debit card total payment volume growth. And then Braintree, their white label product, starting to return to growth after shrinking for a couple of quarters in general. They have a strong first half of the year. They're raising full year 2025 transaction margin dollar guidance. They're raising EPS guidance. They're introducing some new things that seem kind of interesting. And really, they're focusing on some of the things that are being successful for them. It's Venmo. It's buy now, pay later. It's pay with Venmo. They're advancing a lot of the strategic growth drivers they talked about during their investor day. And that's really seemingly working out well for them, driving some of that revenue growth. That's turning out to be better than expected. They're introducing PayPal World, bringing together digital payment systems and wallets on one platform with a lot of users. They're driving profitability from their white label product. Again, Braintree total payment volume was shrinking for the last couple of quarters, starting to return to growth, kind of flat this quarter, but then their expectations for the latter part of 2025 is that it returns to growth, which is always nice to see. They have a lot of small business offerings that are out there. And then I think some of the things that people are more interested about that aren't really big contributors to the top line or bottom line yet is some of their agentic stuff, some of their advertising stuff that's going to be a high margin business. And then obviously some of the crypto and stablecoin stuff. Again, stablecoin and crypto, not a big part of their business, but their stablecoin is approaching $1 billion in market cap. Again, still a small player in the stablecoin space, but they're really trying to grow it. They're giving you 4% on your PayPal USD coin or whatever it's called. They're launching pay with crypto, so you can pay with 100 different cryptocurrencies at a 0.99% transaction fee, which is, again, much lower than credit cards. So some of that stuff seems very interesting. It remains to be seen whether or not that becomes a big growth revenue bottom line driver for them, but for now it's just a add-on to whatever this business is already doing and where it's being successful right now. And getting back to the snapshot, again, 6% total payment growth, 5% revenue growth, transaction margin dollars growing at 7 and 8%, whether or not you exclude or include interest on balances. Non-GAAP EPS growing at 18%. I think the market looks at this and says, hey, adjusted free cash flow down 42%. That's not great, but for 2025, they're reiterating their $6 to $7 billion free cash flow guidance, so they're not worried about the timing of working capital that's impacting their Q2 results. They're raising their full year 2025 transaction margin dollar guidance and their EPS guidance, which is nice to see. Accounts continuing to grow. One thing that's a bit worrisome is that the number of payment transactions is down about 5%. I think some of this is driven by some of their Braintree offerings. A lot of transactions go through that, and they've become more selective around the contracts they're renewing on the Braintree platform because they want to focus on transaction margin dollars over just low margin business that Braintree historically has had under the old leadership. So that's a change in mindset, and that's going to lead to slightly lower payment transaction volume. But in the long run, hopefully that means that the payment transaction volume that remains is higher margins, which will be good to see. Jumping into their total payment volume mix, which is important. Again, it's the high margin business versus the low margin business. You can kind of see that PSP, this is their Braintree product, starting to slow in growth in the last couple of quarters. And a lot of that is on purpose. Like I said, they're renewing higher margin business. They're letting go of lower margin business. So total payment volume, number of transactions there becoming smaller and smaller. And the growth is falling off a bit, but now it seems like they're confident that it's going to stabilize and return to growth starting in Q3. P2P and other consumer, which is Venmo and Pay with Venmo and debit, etc., starting to accelerate in growth. Branded checkout remaining steady. You can kind of see the branded experiences accelerating. Venmo accelerating. The revenue growth from Venmo at a growing at a good clip. Still only 18% of the business, but this is, again, a higher margin business, a good brand that they have out there. PayPal is obviously a pretty good brand, but I think Venmo is one of the better peer-to-peer brands that are out there, and you're getting that within the mix of the PayPal platform, and that's growing and accelerating in growth, which is really good to see. And they're really pairing other things within the Venmo brand, whether it's Pay with Venmo or Venmo debit cards or whatever. I think that's going to be a good growth driver for them in the future, and that's really nice to see. And again, this is just a repeat of what we already saw, but again, it's nice to see that margins are actually improving year over year. And then looking at guidance for 2025 and Q3 2025, 2025 guidance is really the thing that I'm most interested in, and it's showing good bumps over the guidance they gave just a couple of months ago. Transaction margin dollars growing at 5 to 6% instead of 4 to 5%. EPS growing at 11 to 14% instead of 6 to 10%. So that's nice to see. Free cash flow remaining steady, 6 to 7 billion. They're using the majority of that money towards share repurchases, some of that money towards capex. But really, this is what you want to see as a shareholder. You want to see growth on the top line, growth on the bottom line, which you're really seeing here, and then free cash flow going towards share repurchases. Because right now you have to think that this is an undervalued company, that eventually the market will realize that this is a company that's still growing, still improving margins, and a 9% free cash flow yield in this market is a heck of a deal. So it's good to see that the management of the company notices that and is using a lot of their free cash flow towards repurchasing shares, because the idea would be you're buying back shares at low valuations when and if the market eventually realizes that, hey, this company maybe doesn't suck and the valuation shoots up. You're getting the combination of multiple expansion plus a lower number of shares on a go-forward basis, which is going to be leading to good long-term returns if that were to happen. So all that is great, but why is the stock down pre-market? Let's just double check that it's still down pre-market. Well, it's moving in the right direction, down only about 1%. I think as investors digest the earnings, they realize that the earnings themselves are actually pretty good. There are some negative things. One of the things that I always look at is transaction margin percentage. Like, what are they actually getting on a transaction margin basis? And in reality, this has been a number that prior to the new leadership was moving in the wrong direction, down to 45% in Q1 2024. A lot of that was because they were growing Braintree at all costs, and that's a much lower margin product. Now they're moving in the opposite direction, where they're growing Venmo. They're focusing more on higher margin business in Braintree. They're growing branded checkout, etc. They're adding some of these added value services like ads, some of the agentic stuff, maybe some of the crypto stuff that will lead to higher margins. But that was leading to margin increases for the last couple of quarters. Now it's moving in the opposite direction, which is kind of a negative thing. It's still better than it was in Q2 2024, but it's down about 130 basis points from Q1 2025. And that's a bit of a concern, something to keep an eye on as an investor. I always want to see this number move in the positive direction or stay steady. I mean, it's not going to go back to 50% anytime soon like it was just a couple of years ago. But now that it's dropping, is this a new trend that they're starting? This is going to continue to drop as they focus more on total payment volume recovery in Braintree, or is this just a blip based on the type of purchases that we saw in Q2 2025, and maybe this will start to recover again? So it's something I'll keep an eye on. But one of the things that was negative to me, besides the fact that you saw some negative free cash flow stuff in Q2, which isn't too worrisome, is this factor that transaction margin is down yet again after moving in the positive direction for a couple of quarters. So that's a bit disappointing to see, but hopefully not a long-term trend, but something that's a short-term blip. Besides that, though, it's hard to complain about this quarter. It's much better than I expected. It's much better than the market expected. Again, this is a company that's trading at a 9% free cash flow yield. This is a company that's using their cash well. They have a good balance sheet. If they want to make an acquisition, they certainly can. If they want to buy back more shares, they certainly can. If they want to issue a dividend, they certainly can. And I think they will in the future. But right now, they're focusing very much on buying back shares. They were sitting at 1.07 billion shares at the end of 2023. They're now down to about 960 million shares after this quarter. This isn't reflected here yet, but you can kind of see the share count dropping quite a bit, and quite a bit more in the last couple of years, as there's a focus on buying back those shares now that the valuation has gone down to pretty favorable levels. This is a stock that was trading, close to 11% free cash flow yield just a couple of months ago. This is a stock that was also trading at 2 to 3% free cash flow yields during the hype in certain stocks post-pandemic. So, it's really moved in a very opposite direction, but now it's gotten a lot more interesting than it was over here for sure. However, if you're a buyer back then, you're certainly not happy. This is a stock that in the last 10 years has returned about 7% annually, but in the last 5 years down about 17% annually because of that spike during the pandemic where the valuation was ridiculous. And now the valuation is, kind of ridiculous in the opposite direction. And disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Here's how I look at the valuation. We've got a $74.3 billion market cap company, $76.5 billion enterprise value company based on the 950 million in shares outstanding post the 22 million shares that are being bought during Q2. They are buying back shares at a rapid clip. But remember, they do have stock-based compensation in the 1 to 1.5 billion range for the last couple of years. So that offsets some of those buybacks. That's one thing that's key to remember. A 9.1% free cash flow yield for a company that's still growing their bottom line, improving margins. That's pretty good in my mind from a growth perspective. This is what I have for the next couple of years, 3.5% for 2025, maybe 4% for 26 and 27, down to 3% for the next couple of years after that. Margins improving a little bit. Most of their cash flow, the $36 billion in free cash flow they're going to generate in the next 5 years, which is about half of their market cap. Kind of crazy. Most of that going towards buybacks, offset by stock-based compensation, leads to a net buyback of $21 billion against that $74 billion market cap, reducing share count substantially if the market keeps valuing this company as it has for the last couple of years, last 2 years or so. Leaves them with about $9 billion in excess free cash flow for a dividend, for additional buybacks, for an acquisition, or what have you. From a valuation perspective, I'm going to assume that the market leaves it kind of where it is right now, 9.1%. I'm putting 50% at 9, 50% at 8, to an 8.5% free cash flow yield valuation. Gets me to an expected return at the $78 price point of 10.5%. If I'm targeting a return of 10%, gets me to a fair value just shy of $80. And again, that leaves plenty of upside if you think the market's going to revalue this company to something like a 6-7% free cash flow yield. At that point, you're looking at a 13% annualized return at 7%, a 16% annualized return at 6%, because you're getting the return from the multiple expansion, you're getting the stock buyback yield, and you're getting the little bit of growth from margin expansion and the top line growth that PayPal is likely going to provide. So I think there's upside from potential multiple expansion, upside from some of those products I talked about. That's kind of why I like this company. You're sort of baked in with a decent return, assuming the company stays steady from the buyback yield. They're reducing their share count by $4 to $5 billion every single year. That's probably like 6 to 7% a year in buyback yield at today's valuation, maybe slightly less when it's offset by that stock-based compensation. On top of that, you're still seeing growth, you're still seeing margin expansion. Their bottom line EPS is up, 20% in Q2, expected to grow 11 to 14% for 2025, and you're getting it at a 9.1% free cash flow yield compared to some of the other stocks in the market. That is kind of a smoking deal. When I look at companies like this, I target a 10 to 15% return from individual stocks. Again, at 10%, it's $80. At 15%, it's $64. I think, this is a conservative assumption in valuation in my mind. If you want to play around with this stuff, you can hit file and make a copy. A spreadsheet will be in the description down below, along with some of the other videos I mentioned. So feel free to do that. Let me know if you disagree in the comments down below. Let me know what you think about PayPal. Let me know if you'd like me to review another company. And as always, like and subscribe. And thanks for watching. Bye.